In this video, we're going to be covering ICT's first presented fair value gap model. I'm going to dive into the rules that ICT uses for this model, how you could set your clock to this model, and then also the timeframes to look for this model on. Now, the first thing that we need to identify for this model is the opening range, which is between 9:30 a.m. to 10 a.m. New York time. We're looking for the first fair value gap within that interval of time. And there's multiple ways that you could use this fair value gap. It's not just as simple as trading the return back into it. There's multiple ways you could use it in both directions. So the first rule is that the fair value gap cannot form on the 9:30 a.m. candle. So if this is a bearish fair value gap right here, candle number 2 cannot form on 9:30. It has to start at 9:31 at the earliest. So the earliest that we're looking for a fair value gap to form within that interval of 9:30 a.m. to 10 a.m. is on the 9:31 candle. Now you might be a little bit confused right now. Think of it like a fair value gap is 3 candles. This is candle number 1. This is candle number 2. This is candle number 3. Candle number 2 cannot be at 9:30. The earliest that candle number 2 can be is at 9:31, just like in this example. So see this bullish fair value gap right here? This is candle number 1 at 9:30. The buy side imbalance, sell side inefficiency, gets created on 9:31. 9:32 does not overlap 9:30's high. So it creates this bullish fair value gap. 9:31 is the earliest where this imbalance part of the 3 candle pattern, the fair value gap, can get created. So just note that candle number 2 of a fair value gap cannot form on the 9:30 a.m. candle like it does here. So that first presentation fair value gap that forms between 9:30 to 10 o'clock, we want to mark that out and we want to extend it to 3:45 p.m. New York local time. So once you can mark out a fair value gap that forms within that opening range from 9:30 to 10 o'clock and make sure that the candle number 2 forms at 9:31 at the earliest, like we have right here, ICT teaches to extend that to 3:45 p.m. New York time. If it's not in a trending environment where it's moving up and down, he talks about it can be used multiple times in both directions. He talks about it being the focal point for the daily range. Make sure you guys do go check out the Inner Circle Trader though, because he is the source of this information and where I'm getting this from. So when we do extend it out to 3:45 p.m., it doesn't mean just because price trades into the first presentation fair value gap that it's a long or it's a short. For example, right here on 9:34, it trades back into the first presentation fair value gap. This is not a long. Even though it may look like it's displacing higher, the underlying narrative is that smart money's getting short up here and they're going to take it to the opposing sell side liquidity. So you need an underlying narrative why to trade off of that first presentation fair value gap. It cannot just be alone, but if you incorporate a bias and other time elements, it can get very, very precise. Right now, I'm going to go into how to come up with a bias using the opening range gap. This is another concept that ICT taught. The opening range gap, this is different from the opening range. The opening range is from 9:30 to 10 a.m. The opening range gap is from the previous day's 4:14 p.m. to the next day's 9:30 a.m. So I'm going to show you guys what that looks like. You need to go on regular trading hours for this. So look in my bottom right-hand corner, see the ETH. This is electronic trading hours. You want to switch that to regular trading hours. Now what ICT taught is when we have a premium gap in the AM session. What's a premium gap? Well, when we're on regular trading hours, if you go on the 1-minute chart, you can see at 9:30 a.m., if you look back one candle, this is the previous day's settlement at 4:14 p.m. If you draw a Fibonacci on that from the closing price of that up to the open of the 9:30 a.m. candle, so all we're doing is the closing price from the previous day's settlement at 4:14 p.m. on the regular trading hours, and we're drawing that fib up to the open at 9:30 a.m. Right here is the midpoint of that. So this is the midpoint of the opening range gap. So see how I have the 0.5 and then this is just the 1 and the 0. We need to focus on this midpoint of this opening range gap because what ICT teaches is that if it's a premium gap, meaning 9:30 opens up higher than the previous day's settlement down here, there's a 70% chance within the opening range for price to return back to the midpoint of this opening range gap. So I know that sounds like a mouthful, but I'm going to simplify it right now. Draw 2 vertical lines on your chart from 9:30 and then to 10 o'clock. What he's teaching here is that when we have a premium gap and we mark out the midpoint of that, premium just means it gapped up. When we mark out the midpoint of that, there's a 70% chance between 9:30 to 10 a.m. that it's going to return to the midpoint of that opening range gap. Go to his channel. He talks about this. So it's not a 70% strike rate with the first presentation fair value gap. What he's talking about here is that there's a 70% chance that if we open up higher than the previous day's settlement, that within the first 30 minutes, it's at least going to return to the midpoint of that. So we could use that for a bias, right? There are other elements that we can consider, like the fact that it opened up higher, took out the buy side liquidity, right? And we also have the opening range gap here. And on the higher time frame, it's in this consolidation. So once it takes out the buy side, it's likely to move kind of back to the middle of that consolidation that it's in. So once we combine these other factors, then this first presentation fair value gap becomes clear. So if we go back to here on electronic trading hours, when it creates that bullish fair value gap, why would we trade it in the direction higher if it was a premium opening range gap? So it's already likely to return back to the midpoint, which is right here. Okay. It took out buy side liquidity. That's 2. And it's in a consolidation. So it's likely to, once it takes out external range liquidity, it's likely to move right back into internal range liquidity or seek the opposing liquidity. Before we do continue, if you guys are interested in learning more about the institutional perspective and finding the draw on liquidity, setting your clock to the market, and more elements through high probability analysis, I do have a Discord. So if you guys are interested in that, you can check that out. First link down below. I will leave a 3-day free trial. I also do have a channel in the Discord where I call the market every single day. I suggest where I believe the market is going towards, which premium or discount arrays should hold. This was from today. You could scroll through, you could pause if you are interested, but this is the type of content that I am posting every single day in the Discord. So there's no reason why we should go long here. Like I talked about, remember when we were just talking a few minutes ago, I said when it returns back into here, even though this is a bullish fair value gap, this isn't a long because other factors are suggesting that it can return back to sell side and to the midpoint of that opening range gap. Remember, it's a 70% likelihood to return back there within the first 30 minutes. When did it return there? 9:48 a.m. So I'm looking for price to trade above this bullish fair value gap. It can wrestle in it initially, but then I want to see it trade beneath it and use it as ICT's inversion fair value gap. So there's multiple ways that you could use this. It's not just simply a bullish fair value gap within the first 30 minutes, gets treated when it retraces into it as a long. No, it can be used in different directions, meaning it could be used for its original purpose, which is a bullish fair value gap long. But in this case, since the bias, that's the important part here, the bias was lower, if it is a bullish fair value gap, we're anticipating that to be treated as an inversion. So this is your short setup here. So you can look for that first presentation fair value gap to be treated as a regular fair value gap or an inversion. In this case, because of the specific context that the bias was lower, it was the midpoint down here and sell side liquidity, we're going to pick to use it as an inversion fair value gap. So you can see from there, it was over a 3R trade, okay? And I would put my stop above this swing high before it traded into the inversion fair value gap. This one could also be used right here. So let's do a quick recap real quick because I know we just talked about a lot. Between 9:30 a.m. to 10 a.m. New York time, we're looking for the first presented fair value gap. It can be used in both directions, meaning it can be used as a fair value gap or an inversion fair value gap, or even a reclaimed fair value gap. The candle number 2 of the fair value gap cannot form on the 9:30 a.m. candle. The 9:31 is the earliest that it can possibly form. Also, you need to have a bias. So there needs to be a reason to target higher prices. There needs to be a reason to target lower prices. In this case, we had the opening range gap midpoint. It gapped up. There's a 70% likelihood that it returns back to that midpoint. Okay, that's one thing that contributes to potentially seeing lower prices. It took out buy side liquidity and it's in a consolidation. So as soon as it takes out external range liquidity, it's likely to move back to the middle. Now we have 3 things suggesting that price is likely to draw lower. So then we could use this first presented fair value gap as an inversion to draw us towards where the draw on liquidity is. That's how you would apply this first presentation fair value gap, not just randomly seeing it within that opening range and longing it right here. So there has to be a context behind it. And if we're not in a trending environment where price is just constantly ripping higher and it is in these consolidations, it can be referred to throughout the entire day and used for multiple trades. It's not just because it used it once here, it never refers back to it again. It could be used later in the day for another trade. Maybe it returns back above it. Let's say it hit the draw on liquidity down here and there was enough of a reason from a bias perspective and a narrative perspective for it to draw back up higher. It can trade above that and we could use it as an inversion, right? So really the important part is the context and a bias behind why price should go where. And then we can apply the entry model after that. So when we come back over here, remember the example that we just talked about, how this fair value gap formed at 9:30, so we can't use that. So we're looking for the next fair value gap within that 9:30 to 10 o'clock range. Well, the first one that presents itself is right here. This is 9:43. We're going to mark this out. Okay. Price leaves it open, trades away, initially treats it as a breakaway gap, which is essentially when price trades away from a fair value gap and it leaves it open and then just continues towards the draw. So when we go to the higher time frame here, you can see that it consolidated on the high, manipulated down, this is after 8:30, and took out this swing low. So it manipulated the sell stops and traded into this rejection block's consequent encroachment, which is the midpoint of this wick from high to low. So that's a key level. And then we also have the sell stops. That's enough of a reason for price to retrace back up and target some degree, some minor degree buy side liquidity pool. So when we go back to over here, right, it leaves it open, trades away, knocks out the stops. Remember, trades into the midpoint and the sell side liquidity pool. Once it starts retracing back up, I'm not anticipating this to get used as a bearish fair value gap, since now there's a narrative underway where smart money got long down here. So they're repricing it higher to offset that long position. Where can they do that? A buy side liquidity pool. So now we're looking for highs to target, and we could use this first presentation fair value gap as an inversion again. So when price trades above it, returns back into it, we have a context and a bias now for price to trade up into the buy stops resting at 5,600 and then a little bit higher. We had these smooth relative equal highs up here. When price trades above this first presentation fair value gap, we anticipate that since the bias is higher, and you can long when it returns down to here. Where would your stop be? Beneath the order block low. So even though it does disrespect it temporarily, okay, the long would still be in here, stop beneath the order block, because if order flow is bullish, this should remain intact. Notice how it's moving past that, trading into this opening price right here. When you have nested PD arrays combined with this first presentation fair value gap, it'll even be more sensitive. And then you can see the long was right here and price spiked in for a quick low resistance move into the buy side liquidity pool. Trades back beneath it. Notice right here, it's trading this fair value gap as resistance. And if you move back here, look where the bodies are respecting this first presentation fair value gap, and then price trades away. So this was two ways that you could have used it: as an inversion right here when it spikes back up, or when it reclaims it as resistance over here after it knocked out the buy stops. So what's it going to do? It's going to seek sell side liquidity. So the context was right in this case because smart money is now short up here and they need to offset that short position to sell stops, okay? Because if they want to buy it back, they're going to take it to where sellers are. So the context matters. And when you're in the right context and you have a bias, this is when the first presented fair value gap is going to be very, very clean. You're going to see it respected, and you're just going to see it take off and go straight to where your draw on liquidity is, just like we see over here. That's going to be it for this video. Hopefully you guys found this insightful. And if you guys would like to see more videos like this, make sure to like down below.